everyone. Thank you for joining us. So in today's webinar, we will be discussing on a very unique asset class, not your usual equities and also not your usual fixed income, but rather into real estate investment trust, which is also more commonly known as REITs. So given current climate, interest rates are likely to stay low for longer, and hunting for yield also gets more difficult. So joining us today is our CEO at SAIF, Dhruv Arora. We are also very pleased to have the head of index services at SGX, Simon, who will be giving us his insights on Singapore REITs. So feel free to keep your questions coming because we have the experts with us today, and I hope all of you are excited as me to get this session started. So over to you, Dhruv.
Awesome. Thank you so much for the kind introduction, Zashan. Simon, it's a pleasure to host you yet again.
It's great to be here once more. Thanks, Dhruv.
I think this world of hopefully the next time when we meet it might be in person again, but I think for now we'll let's get this started. So I think Vivian's helping us the slides. So if we can just get on to the next slide. Just to give a quick overview for those who know maybe not as much about SAIF, is that we essentially have three products that really make a difference for us, right? I think the first and our flagship product is what we call the global product. This product essentially is targets on managing the risk of your portfolio, and it's a blend of equities, bonds as well as gold. So we try to focus on a risk which is suitable for you, and then we manage and we rebalance your portfolio to keep within the risk profile. The next product in the middle of your screen is the Equity 100. This was actually just launched about 4 months ago, but has had incredible traction because what we leverage out here is a smart beta strategy. So our goal out here essentially is to look at those customers who are looking for something which is a bit more of the medium to the high risk side, and traditionally with the perspective of having to take that high risk for the potential of higher returns, right? This essentially only invests in equities, 100% in equities, and eventually end up having access to about 1,500 odd stocks globally through this portfolio. All your popular names, Apple, Google, Amazon, so on and so forth. Now, today's session is actually not about these two, and today's session is more about the third one. If you want to know more about our global or equity 100 portfolio, feel free to join any of our regular webinars where we cover this. But today actually is about the SAIF REIT Plus, which is actually one of the very, very unique offerings of SAIF. I think many will ask us, there are a few other of these digital wealth managers, how are you different? And we have a few reasons, but I think one thing that I could stress off is that I think we're the only ones who have something which is very unique on the REIT domain. And this would not have been possible without Simon and his team, which have been incredibly supportive in helping us build something which is both unique as well as much better than I guess the conventional REIT indices. Now this tracks the iEdge S-REIT Leaders Index. If I'm not mistaken, and Simon, please correct me, I think we're still the only publicly available option which tracks this index right now. I'm not sure.
Well, there is futures contracts on SGX, however.
Futures contracts, all right. Publicly non-futures contract. And I think as Yajun suggested earlier, right, I think one of the things that really attracts real estate, and I think something that even Simon touched on is generally the fact that they have to pay 90% of their income out in dividends, right, which led to a yield of about 5.1% last year. There has been a bit of a correction, but compared to where interest rates have come down in banks, I think these numbers are still extremely high and positive. And on top of it, we also add on optional risk management for those who want a level of risk control. Now, if we can go on to the next slide, without much ado, I will basically pass it on to Simon. So Simon, over to you.
Thanks.
And just as you say, next slide, I think.
Sure.
On, right? So.
Sure, thanks, Dhruv. So what I'd really like to talk about today is the S-REIT Leaders Index, which underpins the REIT Plus portfolio at SAIF. We're tremendously proud of our partnership with SAIF, and it's a great endorsement to have SAIF partner with us and to have their REIT Plus portfolio tracking our index. Last time I spoke to you, I actually introduced the iEdge S-REIT 20 index. So what I want to be able to talk about is the evolution of the S-REIT 20 into what is now the S-REIT leaders. There are a number of reasons as to why we made the change from the IAG S-REIT 20 index to the S-REIT leaders. So we'll go into that more specifically. Then I'll also drill down into more of the attributes of the S-REIT leaders index, which, as I said before, underpins and is a major component of the REIT Plus portfolio at SAIF. The change from the IAG S-REIT 20 index to the S-REIT leaders was really inspired by the fact that the S-REIT market or the market for REITs in Singapore has grown significantly. So the market for REITs at the moment within Singapore is approximately 45 listed property trusts with a market value of about $100 billion. When we initially launched the S-REIT 20 index in 2015, it was obviously a much smaller market. So in order to stay relevant and be representative, we had to conduct a periodic review of our existing methodology and make some necessary adaptations that both improve the liquidity and improve the diversification of the index. So for investors wanting access, diversified access to S-REITs in a passive manner, this is now a vastly improved vehicle through which they can do so. So much so that the improvements led to CFTC certification. The CFTC is actually the derivatives regulator in the USA, which actually has very stringent requirements around liquidity and diversification, which now is successfully complied with through the methodology that we have on the S-REIT Leaders Index. So some of the reasons why we changed, one was really market representation. As I said before, throughout the course of the last 5 to 10 years within Singapore, the REIT market has grown significantly, both in terms of the number of listings as well as the size of the market. We introduced liquidity enhancements with the introduction of new products linked to our index. Such as, for example, the REIT Plus portfolio, as well as the futures contracts that are now trading on it. We needed to introduce these liquidity measures as it makes it less prone to short-term market volatility. Also, leading on to the next point, as we enhance liquidity and as we improve the market representation, it becomes a more suitable benchmark or an index for product issuance. So what we're really keeping in mind is the necessary, not just the necessary global regulatory requirements in terms of ensuring that an index is representative and liquid, but also ensuring that it is investable and tradable and fit for product issuance. Ultimately, this leads to a better outcome for investors. Next slide, please, Vivian. So I won't go into too much detail on this slide, but basically this shows in parallel exactly what the changes are between the former S-REIT 20 index and now the S-REIT Leaders Index. The most obvious change is the name. So the index is no longer capped at 20 stocks. However, it does still represent the largest and most liquid S-REITs that are traded on SGX. Leading on to the next point, index size. It's no longer capped at 20 stocks. So we allow the index to float, so to speak. So the index is unbounded, provided that a REIT meets the necessary liquidity and market cap criteria, it is then eligible for inclusion without setting a quota on the number. So at the moment, I believe we have 26 REITs within the index as opposed to the previous cap at 20. There is, as I mentioned on the previous slide, more stringent liquidity criteria through a minimum threshold on average daily traded value. For new constituents, that's now $500,000 US. The main reason why liquidity is important, particularly in the case of REITs, which are traditional buy and hold instruments, is that when you're dealing with significant sums of money that track your index, you don't want any significant changes in price to take place as a result of market impact. These market impact costs do, at the end of the day, affect investors, and we want to try and mitigate these market impact costs as much as possible. And as a result, we've introduced significant liquidity enhancements to the index. There is also a minimum size criteria of also $500 million there. So the main reason why we've introduced minimum size criteria is to ensure that there isn't a long tail in the index. So you have a heavy component of REITs at the top end in the top 10, but then you can very quickly get into a very thin tail of very small REITs, which makes it a much harder portfolio to manage. So we've introduced minimum size criteria as well to ensure that there is effective diversification right across the index. On the next slide, please, Vivian. So if we do a membership comparison between the former S-REIT 20 index and the S-REIT leaders, you'll see that the green, those highlighted in green, have actually been introduced into the portfolio as a result of these rule changes or as a result of the methodology that we have implemented now. Clearly, you can see a healthier representation of REITs now within the index, with the addition of the likes of the Manulife US Real Estate Index, as well as Ascendas India Trust. So what was previously capped at 20 was obviously quite a liquid benchmark to begin with. It was representative of the market. I believe about 80% or up to 85% of the REIT market was represented. However, now with these enhancements, you can see that the diversification has been improved significantly with the addition of new REITs that are eligible into the portfolio. So I'll go into some of the attributes now of the S-REIT Leaders Index itself, and the methodology related to it. The number of stocks at the March rebalance was 27. Now the most recent September rebalance is actually 26. As I mentioned before, we do have stringent liquidity criteria in terms of a minimum of $500,000, and on size, a minimum free float of $500 million. Again, really trying to address the issue of liquidity there. There is a stock or a REIT cap of 10%, which means that each rebalance date, we try and ensure that no single REIT exceeds that 10% threshold. However, I will point out, and as you will see later on, between these rebalance dates, the REIT percentage can move beyond 10% in response to market movement. And as you're well aware, there has been a lot of market movement. So you will see a divergence beyond that 10% cap. But notwithstanding that, the 10% cap is very important to ensure that you do not result in a very top-heavy portfolio that has, say, a 30% exposure to one REIT, which can be quite possible under some market circumstances. This rebalancing or update of the portfolio takes place twice a year. And SIFE, who track this portfolio quite well through their REIT Plus strategy, actually mimic all of the changes that we implement on a semi-annual basis. Next slide. So if we look at the performance summary of the index as at 31 October 2020, one thing to highlight here, particularly if you look at the total return of the index, which is really what you want to try and pay attention to, because of the fact that the total return represents obviously the capital appreciation or the capital price movements of the underlying REITs with the dividends or the distributions reinvested into the portfolio. So what you see over a 5-year period is an annualized return of 9.86% per annum. This is in spite of the 36% drop in the index that happened in March. So in spite of the volatility that we've had throughout the course of 2020, we have observed over a longer term time horizon over 5 years that the total return is still very, very robust with a 9.86% return. And clearly, as an investor in income generating assets, you invest in REITs with the view to obviously accumulate wealth over a longer term time horizon. It is not an instrument that you get into with the view to execute a particular type of trading strategy. It's not a tradable instrument to realize a quick gain. Ultimately, this should form the basis for long-term wealth accumulation through an income-generating asset. Clearly, if you wanted to get into more of a tradable vehicle, then there are instruments on SGX, such as daily leverage certificates, that where you can exercise your right to behave a little bit more actively. But here, what you see over a 5-year time horizon, in spite of the volatility this year, is very robust returns over a 5-year historic time horizon. On the next slide, in terms of the attributes of the index, I mentioned the 10% cap earlier, and you can see that Capital Land Mall Trust has significantly gone beyond that 10% cap since the September rebalance. What we've had is a great deal of dispersion in terms of the returns within the REIT portfolio. The main reason for this is that investors are definitely expressing their view across the different underlying real estate assets. Obviously, those that have a heavier component of industrials have been punished, whereas those that have a greater component of malls and shopping mall trusts, those that are more linked to consumer discretionary elements, have reacted more positively as the sentiment around the recent pandemic starts to improve somewhat. So the relative outperformance of Capital Land Mall Trust to the other REITs has resulted in its weight being a lot larger in the index relative to the other REITs. Overall, however, the appeal of the underlying portfolio is the fact that it is significantly diversified. So if you find that retail REITs may not perform during a certain period, that'll be offset by perhaps the office equity REITs. Or similarly, if the office equity REITs do not perform well over a particular economic cycle, then that may be offset by industrial and warehouse equity REITs, or perhaps even the retail equity REITs. So the fact that the index is actually well diversified across the real estate assets means that from an overall portfolio perspective, your risk is ultimately reduced, or your concentration risk is ultimately reduced, given that you're spread across multiple different types of REIT assets. Beyond the actual asset type, you also do get exposure to other geographies. This isn't exclusively based on exposure to Singapore. So you do get exposure to Australian property assets, as well as Hong Kong, China, Japan, and USA, as well as quite a few others in the others category, India being one of those, as we evidenced previously, as Ascendas India Trust. So beyond the asset diversification, you also get geographic diversification, which is important because different geographies go through different economic cycles at different times, and other economies also have different stimulus measures over time that could also affect the portfolio. So this diversification across geographies through one vehicle, through one diversified vehicle is a very powerful way to limit your concentration risks. I believe that's all I wanted to cover today in regards to the S-REIT Leaders Index. I'll definitely be addressing questions later on in the Q&A, and I'll now pass it over to Dhruv.
Thank you so much for that, Simon. I think that's extremely helpful. In fact, what I would say is that it might be good to maybe take a couple questions right now, if you'd
Sure.
like. So I think one of the questions coming across is, isn't the overweight of CMT due to the merger with CCT rather than its relative outperformance? Like, is that the reason for the, I think you showed roughly some 17.6%. Is that the correct reason?
So there is the corporate action that definitely affected its weight, but also the relative performance, as we saw. We analysed the portfolio quite recently and questioned the significant size itself. It wasn't just the corporate action that impacted that, but also the relative performance. We saw Ascendas, or the A-REIT, which is traditionally the largest REIT within the portfolio, suffered quite a lot during the October month, primarily due to a sell-off or outflows related to industrial trusts. With that sell-off, that was actually offset by capital appreciation from Capital Mall Trust. So the result was really twofold. Yeah.
Mm-hmm. Understood. Okay, that's good. And there's one question that keeps on coming is that, like, given there's the decline in the retail, right? I think you touched on this point earlier. What is your view? Like, I think when you showed the index breakdown, I think roughly about 22% was retail focused. Do you still think in general the index is worth tracking? Do you expect the retail composition to actually come down? And again, thinking of a 5-year perspective.
Yeah, look, I mean, it's difficult to make a call and be get the crystal ball out and say what would happen in over 5 years' time. I mean, ultimately, what you're seeing at the moment is obviously a secular trend towards online shopping. Yes, that's obviously very prevalent. And a lot of the stores that we know and love that we used to see in shopping malls have closed down, primarily because of the fact that you can buy things online through Amazon and also through Alibaba. So obviously there is a secular trend, there is a shift towards online shopping, and this pandemic has actually accelerated that shift. Given that most people are staying at home and choosing to make purchases from home. So there has been a catalyst for a greater shift towards this secular trend of online shopping. Yeah. However, ultimately people still like to get out. And I dare say that once the pandemic has subsided, I think consumers will exercise their right to be, to go to shopping malls and to be able to, experience those things that they missed over the last year. So I tend to think that, yes, there is a secular shift towards online shopping. However, we as humans are creatures of habit, and will continue to embrace the physical world as well as the virtual world. I think they can coexist.
Yeah. And I think I like to add, I think from our view also, like, given the fact that the sector has already faced some sort of a correction, and you said recently it's actually back outperforming as the fears subside, and globally also you've seen this big shift from growth coming back to value, outperformance of markets like Japan and all being a prime example. I actually think having that diverse, if you're looking for a 5-year horizon, right? As one of our customers asked us, I think having that diversification actually, as we joke, it's your only free lunch in town, right? Because where the sector goes, and if there's a genuine vaccine and people do come back, and if people are back to normal, why not, right? I think I was seeing this article the other day in Straits Times, which said that, oh, there's one side you're saying Robinson is shutting down. Is it bad for the Singapore, the malls and all? But then you look at the lines outside the Apple store, and they are just sneaking forever, right? So it's a bit of a chicken leg. And I've always believed that if something sustains for a long time, then we will like repurpose, right? I mean, you've seen shops getting converted to houses and houses getting converted to shops, right? And I think that is something which I think will happen as we evolve more and more in some way.
Yeah, or nightclubs being converted to spin studios now. Yeah,
yeah, exactly, right.
So look, I think we tend to underestimate our ability to evolve and to adapt.
Yeah,
we're definitely starting to see that at the moment. Yeah.
I always take this prime example as real estate in some of the big US cities got very expensive. Essentially, a lot of offices, they moved out, and there was lesser space left in these offices space, right? Because it was too expensive and they couldn't get the value for money. And then the question was, oh shit, this is going to spell doom for it. And in many of these cities, it's basically end up becoming Amazon fulfillment centers, right? Because they want to give that prime delivery and they can't get it from the warehouse in the center and so on and so forth. So that level of repurposing is something which will always happen. So I always say, as long as in Singapore is limited land, and I always believe that it's always going to be it's a sector which I think should always be a part of your portfolio in some ways.
Well, look, I mean, if it's the repurposing is a very important point. So while the CBD at this point, perhaps is not as relevant as it was, this time last year. What this does is it presents an opportunity to fragment the workplace a little bit more. And then what you're seeing is overseas is, is the proposition of moving centralized headquarters from, from a city like New York, for example, into several different hubs in the suburbs that can facilitate meetings for employees that actually live a bit further out from Manhattan. So
yeah.
A lot of corporations are changing the way they think. They are rethinking the way in which property assets will be managed. And they're rethinking the way in which people will consume as well as work on a day-to-day basis. So this crisis certainly presents an opportunity, and we're seeing how we're able to adapt and evolve. And Dhruv, to your point, I mean, the index itself is quite well diversified. So if retail is lagging, then there is scope for industrials and to outperform and to pick up over time. So the beauty of having a well-diversified portfolio is, when you do experience cyclicality, then there are segments that are able to benefit while others may lag a little bit.
Yeah, no, I think it's very interesting, and there's so many aspects, right? I think we recently were lucky enough to host the Keppel REIT, CEO at one of these webinars, I think a few months ago. And he made a very interesting observation. He's like, even when we get back to work and people are saying, oh, it's going to be half and half, do people need that much space? And he pulled up some very interesting statistics. He said, on average, the space that the office worker has today, or like pre-pandemic, has shrunk by almost 30 to 40% in the last decade. And he expects now, when people do get back and all these measures in place, there'll actually still be the same demand. So yeah, maybe the amount of space you might need is the same, but you might only have 60% or 50% of the people in the office, right? So I think those things, are something which is also playing a big part. I mean, I was looking at the numbers, it was from a 36% drawdown, we are still like right now year to date at 11% or so, right? I mean, that's a significant move up, right? It's not like, it's a very significant move in many ways, right? So
the most violent drop was 36% in March, and we've regained most of that ground throughout the course of the year.
Yeah.
And as I said, it's different segments playing their part as part of that rebound, depending on the cyclical nature of it. But more to your point earlier, the value of money has completely disappeared.
Yeah.
There is greater demand now for risk assets and greater demand for assets of scarcity.
Yeah.
So obviously, given that money is being churned out and printed and losing value, and in fact, in many places, going into negative returns, then that just means that investors are going to demand more real assets or demand more risky assets as they try and attempt to stoke inflation. So this obviously results in a more positive outcome for income generating assets such as a REIT portfolio.
Yeah, no, that's a very, very good point, right? I think with all this money printing that's been going across the world, right? I mean, your saving bank account wasn't what it used to be, right? I mean, it never was good, but now it's terrible. Let's put it that way, right? So I think that chase for yield is going to be there. I think let's take a few more questions. Jasmine, what do you think, right? I think I see a lot of questions. I think we should start answering them, or else we'll never get anywhere. So
yeah, definitely. There is a long list of questions that I'm just consolidating to for Simon. Okay, so the first question is actually, your thoughts with regards to the pros and cons when it comes to Singapore REITs over physical property.
The most obvious answer to that one is liquidity, right? So you can get access to property quite easily through a REIT portfolio, and you can sell out of it. There's a very active market, whereas you invest directly into property assets. It's very difficult to offload, very difficult to maintain. If you're buying, HDB or a condo and you have tenants in there, you have to have strict oversight in terms of what they're doing with the property as well. And there could be some high maintenance charges, of course, which may have a tax benefit as well. But obviously, the main advantages of accessing REITs, through SGX is the fact that it's a highly liquid way to get exposure to real assets, and you don't have to worry about the maintenance as well. So obviously, the cons, you obviously can't do improvements to a REIT portfolio. I mean, if you want to renovate or enhance a property, or you fancy yourself as a bit of a developer, obviously you don't have an avenue to do that through a REIT. So there are some obvious tangible benefits to owning your own property and having some hand in appreciating its value. But then again, you're stuck with the liquidity issue. When can you sell it? If there's a particular market cycle, if there's new cooling measures introduced by the government, there's obviously a lot of elements of uncertainty in regards to owning your own property and having the ability to offload it.
Right.
Yeah, I think one more point that I would like to add is that the thing that we speak about diversification, right? At least through cyclicality, right? You really, I mean, you might have, I don't know, $100 million to truly diversify across real estates, across industrial, retail, and all. But for majority of audiences, which might realistically have at best wealth for maybe one or maybe two properties, you really can't, like, you can't go and get an industrial plot, right? With $1 million in some ways, right? So I think that's also like a very big plus point, especially in these volatile times where you have that phases of outperformance of a particular sector over the other.
Yeah, well, the average investor doesn't have $10 million to invest in a property portfolio, right? I'm sure that it's diversified. So if you well done, congratulations. But on the average,
then I'm just happy that I'm happy and curious why you on this webinar. That's my question. So but, let's put it that way. Great. All right.
So before we move on to the next question, right? I think we have a viewer who actually wants to retake a look in terms of like the breakdown of the index itself.
Okay.
Yeah.
So that would be the components.
Yes.
Okay. So that's the right slide. Yeah, exactly. So the 26 members there.
Correct. So then to Simon is that, if we were to actually compare this to the Nikko AM REITs, what would be the key differences in terms of like the allocation and performance?
So the Nikko AM REIT actually has broad-based exposure to Asia, ex-Japan. So it's not just Singapore REITs that you get exposure to, you're also getting exposure to Hong Kong REITs, for example. It is a broader portfolio in the sense that you do get more exposure. The performance, I haven't seen the performance of the Nikko AM portfolio recently. However, one of the things that you have to consider when you do get access to a more diversified portfolio that covers more than one geography in terms of the underlying components is that you're exposed to not just the risk of the underlying asset, but also you're exposed to FX risk.
Yeah.
So with the IHS REIT Leaders Index, you don't have such exposure to FX risk through the index, but you do get the benefit of the diversification through the underlying geographies. But again, it's not really an apples to apples comparison because the Nikko AM product does cover the broader region, whereas the S-REIT Leaders just covers those REITs listed on SGX.
Right. So as a follow-up to this question, okay, what would be the overall dividend yield that our viewers can actually expect from this REITs portfolio?
So over the trailing 12-month dividend yield as of today is 4.4% based on trailing 12-month dividend yield. So that's the most recent update on dividend yield that we saw. Obviously, this changes over time as the market moves and obviously as distributions are paid out. So that dividend yield is not static. As Dhruv said previously, there is a point in time at which the dividend yield was 5.1%, I believe Dhruv said. So it does generally fluctuate between 4 to 5 and even sometimes 5.5%. The key point here is that it's not a portfolio that's optimized for yield. What we aim to do with this index is to be representative as possible in a very liquid format. As soon as you try to get smart with an index for a fairly narrow segment of the market, it can lead to distortions, and while the in-sample or the backtest may look good in these yield-enhanced concepts, on an out-sample basis, once they go live, they do not deliver the desired results that they're intended to achieve. So some people try and get a little bit too fancy, so to speak, with a narrow segment of the market, when ultimately what we try and do here is give you simple and liquid exposure in a very well-diversified way, which addresses the issue of risk more so than anything else.
Right. Okay, so I do have a question to Dhruv. Okay, so what would be your take in terms of like the outlook for 2021? Interesting thing is that this viewer actually wanted to compare with equity 100. So in your view, which will actually benefit more?
So if I knew the answers, then I think life will be very, very easier. I think they both are actually fundamentally different products, right? And I think I feel you have to think of it like the REIT is Singapore dollar based. It's more of a passive income yield kind of an output, whereas the equity 100 is more global in nature and it's USD based, right? So I think it's also a function of what is your base currency in which you are investing, and also what you're really expecting out of the portfolio. I think it'll be very tricky to say where these two go, because I think the real estate generally, over a long term, I think obviously I'm very positive, as you've heard me before, about it. But I think that tectonic moves can potentially come depending how sooner and how quicker. The news of vaccine is generally good, and if we get back to the workforce quicker on, some of these aspects will actually fast track this recovery over. So I think it's going to be it's not really an apples to apples comparison. So unfortunately, I really don't think I can help on that front.
Right, exactly. And just to add on, I think this also really depends on like the investors' personal circumstances, right? As well as like the financial goals. So we can't really compare this, but the best way is always to, schedule a session with the advisors. So then, we can actually, tailor a solution based on your financial situation. Okay, so maybe just one more question to Simon. Okay, so this is actually with regards to the recent merger. So between the CMT and CCT. So how is it actually being classified in the current index based on its sector?
Yeah, so we do not go through a specific sector classification. I believe at the moment it's still classified under retail. If you look at that breakdown that we observed before. Post merger, we'll probably reevaluate the breakdown in March, which is our next rebalance date. But when we go through the construction of the index, we do not specifically identify the subsectors that should comprise the index. The subsectors are an outcome of the construction methodology. It's not an input. What we've done through the introduction of our diversification rules in terms of limiting the cap, what we've done in terms of liquidity criteria, as well as introducing more members to the index beyond the 20 that we've had before, has resulted in that subsector breakdown that you saw on the other slides. So the subsectors are an outcome and not an input. In terms of the classification, again, I'll stress that this is likely to change during our March review, which happens in March 2021.
Got it. So should we take a couple more questions? I think let's get on them. I think one then, I think someone asked that, does the SAIF REIT Plus track all 27 of S-REIT index stocks? We actually track, I would say, about 20 of them. And of course, this number also, we are also flexible, as Simon mentioned, to keep on changing. I think for us, the key goal is to replicate the index performance to a 99% plus accuracy, which is what we do. In fact, right now, the last count when I checked, we were 99.5% tracking the index. So literally a very, very, small deviation from the index, right? I think, and that is like very acceptable when you're tracking an index, because once the index changes, then even we need time to adapt and change and buy in and out and all that, right? But in reality, if the index is essentially what this means is that if the index is going to get a 10% return, our product will get a return which will be 9.95 to 10.05, right? So it'll be very, very close. It'll be very, very marginal in its outlook.
Yeah, it's actually on that point. It's actually somewhat unusual for any tracker of an index to track every stock. So this sampling process is quite prevalent, and it's actually a better outcome for investors in the sense that you've got very low tracking error, but at the same time you're being highly representative in a very efficient way.
Yeah.
So I think that's the important point to make about sampling.
Yeah, no, that's exactly a good point, and I think that's something even in our methodology, right? And of course, when we feel for some reason to actually extend that count, we will. But really, I mean, if you look at the top, like even the top, I think 15 constituents will be the same across both the indexes in some ways, right? So, yeah.
Yeah. So one interesting question over here is actually, pertinent to Asian exposure. So one of our viewers actually mentioned that, for SAIF, we don't actually have an Asian equity portfolio. Do you think that, the REITs portfolio actually serves as like a good proxy, aka in terms of giving clients this Asian exposure?
I'm tempted to say no, because at the end of the day, to get proper Asian exposure, you have to be cross sectors, right? And REIT is after all one sector. That being said, the way how we thought of, when we actually build products is that there are products that help you to serve your needs in the economy you're in. So for example, the REITs, I think, is a great option when you are in Singapore, and it gives you that exposure to a perspective. But when you go international, then our view is that it should be something a bit more global, which happens through our Equity 100 or our global offering per se. The idea is that if you start mixing the SGD and Asia, then I think the point that Simon alluded to earlier, you again start taking that whole risk of, okay, let's say if I invest in something that's in Hong Kong, how does that actually impact, a Singapore-based investor, because the currency is kind of currency play, so on and so forth. So I don't think this is a proxy for Asia portfolios. I would think more of it that if you want exposure outside home country, i.e. outside Singapore, you look for a global or an Equity 100. But if you want something within, not to have that currency risk and, keep it within, the same currency that is your base currency, presumably Singapore dollar, then you go for a REIT offering.
I think it does speak to Singapore as a regional hub, however, and as Singapore is, obviously a large part of Singapore is very much a regional hub, and REITs are a direct beneficiary of that value chain that exists as part of being part of the regional hub. Obviously, the relative stability of Singapore within Asia is of tremendous appeal, not just to regional institutions, but also global institutions that look to have a presence in Asia. So I think Singapore is certainly a beneficiary in that respect.
Yeah.
And however, I tend to think that the question is more positioned in terms of more general equity exposure across Asia Pacific. And Dhruv, you're quite right. While REITs do represent a significant component of the value chain for Singapore as a regional hub, I tend to think if you want more diverse exposure across Asia, you need to do it across multiple sectors and geography.
Right. I think we should take a pause on the FAQ. I think Dhruv has some more slides to cover.
Sure. I mean, Q&A is always more fun, to be honest, Ajwin, but you say...
Oh, else.
I'll follow what you're saying. No, but I mean, I think, in wake of time, I think that's probably a good idea. Let's get through this, right? So just a few more slides. So we'll try to keep this brief, right? So, of course, the goal is to track the iEdge Leaders Index, right? But what we realize is that one option is to have 100%, focus on the REIT side. And then for some of the customers, who wanted a little bit of a safeguard against very volatile moments, they actually quite like the risk methodology that we use for our global portfolio. So what we do is we take the iEdge index and then we blend it with Singapore government bonds. And in periods of volatility, we actually, sell the REITs and buy the bond. And in calmer environments, we will, end up, how do I say, selling the bonds and then actually buying back the REITs, right? So what you will traditionally expect is that in a risk managed approach, you will, over a long time, you might actually feel a lower, output. That's because, of course, there's a lower exposure on average to REITs in general, right? And then you have bonds. But I think what can help is that if you're a relatively conservative investor and, you are concerned of, drawdowns, and I think a prime example was, just to give you an example, the portfolio on the left in March, if it went down 36%, the portfolio on the right was down maybe only 18 or 20%, right? So I think giving that level, depending where you are, some people actually prefer the risk managed option. It's quite easy. You can just sort of flick off a switch. You can do it at no cost. But there are two options, whether you do want the risk management or not. There's a minimum cap of 50% for REITs in the risk managed option also. So you'll always is at minimum at 50%, but in calmer markets, it can even go up to 100%, right? Generally. Next slide, please. And this actually, is one of the things which actually gives you an example, right? Like what happens, if there was 100% REIT and then, a REIT with risk management, right? Now, because the REITs have still had this year generally negative, though they both were similar in early Feb. If you look at till date, right, actually the risk management thing has outperformed. Now, having said that, over a long duration, if you're going to be a long-term investor, then perhaps, if we look at purely at numbers, then essentially the REIT 100 will be slightly higher, in output because, but as I said, you have to be prepared for that, that sharp down, and then be honest to yourself that you will not actually exit out because, for even the most sensible people, when you see that 35%, 36% correction happening, as you can see from that dip, in that blue line, you obviously will panic and, you'll be tempted to essentially sell out, right? And that's why if you see that, if you look at, whether you look at dividend yields in some angles, though the REIT will look better, but when it comes to, phases of such kind of volatility, then maybe a risk managed might be a better, optionality for you. Next slide, please. That's a very quick, overview of the team, right? And a bit of, our history. I think, I guess the key point out here to highlight is that, that, we are, well, it's 30 here, but actually we're close to about 37 now. We do come from a very, diverse pedigree of leading financial institutions. Myself, like most of my career was as a trader with UBS. But, if you see, we have people not just from your big banks like Goldman Sachs, Morgan Stanley, Jajuan is from Citibank, but also, from technology companies and consumer tech companies such as, Lazada and Procter & Gamble for that matter. And yeah, the other key point is that, I think it's actually interesting because we now get less of these questions. But yeah, as some of you might know, we had actually raised a very significant Series A round just about not less like 6-7 weeks ago. So as a business, there's a lot of exciting, things coming up. But more importantly, as a prudent investor, we are here to stay. I think that's the key point to mention in this slide. And then as a quick, hygiene factor, I think it's important to mention that, we are regulated by the MAS, we have a fund management license, but also when you, transfer funds through us, you do transfer it to a trust account at DBS, which is completely kept separate and segregated to our own, in fact, even our own banker is completely different, right? So our, outcome should not really impact your assets because your assets are completely kept separately in a segregated account. If it's cash, it's kept as DBS, but securities are kept with Citi, if it's Citibank, if it's US and HSBC, if it's Singapore. Next slide, please. A quick overview of how to start for those new on our platform. It's very simple. You can either download the app or go on the website. You can choose between the different portfolios. You can see a bit of forecasts, and if you like the portfolio, just hit confirm, transfer the funds, and it's done. In fact, for those of you joining us from Singapore, we also have onboarding via MyInfo. So the actual onboarding is probably just about 3 to 5 minutes. It's very, very quick. And thereafter, there's a beautiful app that can constantly keep on telling you about how your portfolio is doing. And you have the optionality to add funds, remove funds, or even transfer them between portfolios to your comfort. So our fees is basically just starting from like 40 basis points or 0.4% per annum. You only pay for as long as you are on the platform. So if you are in that tier and if you're here for 6 months, you only pay 0.2%. Now, the beauty of this is that there is nothing on top. There is no trading fees. There is no entry, at least for the REITs, because we actually buy the underlying REITs. There are no other charges, frankly, right? Because we essentially, there's no entry, there's no exit, there's no minimum balance. You can withdraw when you want. You can rebalance when you want. And where, of course, ETFs are used, at least in some of our international products, we do, filter out to choose very low cost, products out there. So that's one thing very good. Next slide, please. Yeah, and that actually quickly, summarizes, the perception. You can start with as little as you want. As you move up the tiers, of course, you get additional, better and more, proactive pricing. A black tier starts at 20,000, and a gold tier starts at 100,000. But in addition to that, you will also have access to wealth experts who will essentially help you better understand your offerings and see how they are suitable to you. So I think it's something that a lot of our customers find really value, and I think something a bit unique to SAIF. So I think something you should definitely leverage off, and if you're lucky, you might get to speak to Xiaojuan as well. So, right, next slide. I think this is one of my most favorite slides, right? I think a lot of people say, oh, Vice is better than DIY. Why should we be paying SAIF and why can't we do it? I think the reasons are endless, right? I think, frankly, if you have to build a same portfolio on your side, I think we ran some numbers. You literally, to replicate the same thing, you probably need to invest, in tunes of $50,000, $100,000 plus, right? But that's not at all, right? I think the comfort of you being able to add and remove small amounts, building towards a long-term investment strategy, the fact that we'll constantly monitor and free of course, update to the latest index with Simon and the team, and they are at the forefront of understanding what is the right index, for people. Essentially, we will update the index to actually, to the methodology that Simon and the team come up with. So that, I think, comfort is actually very, it's priceless, because not only is it comfortable in terms of you not having to do the load, but imagine the brokerage charges you will have to incur for each of those lines, and trading in, trading out, so on and so forth. And same goes even if you use ETFs and all that. I think the management fees of themselves is higher than SAIF. Now, one very unique thing, and I think Simon, you had shown this in one of your earlier charts, the difference between total returns and where you reinvest dividends, and then without reinvesting of dividends. And it's actually a great slide, and I think we might want to steal that from you, because the difference between the two is roughly about 50 or 60 basis points in an annual performance. And that is the power of reinvesting and the power of compounding. Now with SAIF, there is automatic reinvesting of dividends, right? And I think that's such a powerful tool, because essentially just that functionality can pretty much pay for your entire fees, right? Which is impossible to do yourself, because if you get even $100 dividend, you'll pay $20 in brokerage. It will never make sense. And that is just one stock. And then there's so many stocks. So invariably, when people just have the single stock, they normally never reinvest the dividends, because the dividend amount is very, very small. But here, because we will automatically reinvest the dividends for you, or manage the rights, or everything else which happens comes your way. I think this is a very, very unique feature to SAIF, which even if you have a ETF whichever comes which charges 1/3 the price, it will still not be able to beat this, right? Because I think this itself will pay for the entire fees, and something which is very, very powerful. And I think it talks a lot about the robustness of the system that we've built, which can accommodate these small sizes and still manage to rebalance it out to give that additional 50-60 basis points to our users. Right, and then lastly, before we get back to Q&A, please feel free to join our upcoming slides. We have the next one, which is on next Thursday, and then we have Timothy Ho from Dollars and Cents, with whom we'll be doing a session on December 3rd. So feel free to sign up, your usual channels on our website or Eventbrite, and especially if you have some of the questions, which we can answer, feel free to shoot them across. Xiaojuan, back to you. Any questions for us?
Yep, there is. So I'd like to take advantage of the fact that Simon is here with us today to elaborate a little bit more with regards to the S-REIT Leaders methodology. So one of our viewers actually wanted to, ask whether or not does the bottom few REITs actually get removed, and then, whether or not they actually do get added back very easily if, let's say, their size and the trading liquidity meets the criteria. And how does this actually affect the returns?
Yeah, so that's a good question. One thing that we implement within our methodologies is buffer rules to ensure that there isn't a lot of turnover. One of the pain points of index trackers is high portfolio turnover, which should be a pain point for the end investor as well, because it just adds to the cost of managing the portfolio. So we do have buffer rules in place to ensure that, you know, once you are in the index, it's not that easy for you to get out. At the bottom end of the portfolio, we do not, that there is potential scope for removal, given that we have minimum size and minimum liquidity requirements. However, as I said before, we do have buffers in place so that once you're in, it's not that easy to get out. That's the one thing. On the other hand, you know, how does it affect performance? Well, if you are at the bottom end of the portfolio, you're less likely to impact the performance. The main reason being is that your relative index weight is low. Because your relative index weight is low, that means you can contribute less to the performance of the overall basket. As Dhruv mentioned before, it's really the top 15 within the portfolio that actually drive the returns of the index.
Sure. Okay, cool. So I don't actually see any more questions. And I think with that, we have come to the end of this session. So huge thank you to Simon for spending your evening with us. So it was an insightful session, and I hope that our viewers have enjoyed it as much as I did. So really look forward to having you again for our future webinars. And also thanks to you, Dhruv. I will see you tomorrow during our morning huddle. Right. So anything else to add, Dhruv and Simon?
Look, it was a pleasure to be part of the webinar. Thank you again for inviting me back, and I certainly look forward to the next one. Yeah.
No, thank you so much, Simon. I think, you know, it's always, we on our side, of course, we try to build platforms, and, you know, we obviously have methodologies on our side, but I think when it comes to index creation, like I've, you know, been in that, been in a bank, and we used to follow indices, and, you know, the amount of effort and energy that actually goes, into doing that. And I think, clearly, even when we were deciding between the different index options available, it was a no-brainer just on the way, how you've structured, and it was very effective in the performance. So thank you for your ongoing support, and thanks for taking time out. To our users, thanks for joining us. And thank you, Jajwin. I mean, I think you've done an incredible job of finishing it in 1 hour and 1 minute, which is, I don't think anyone has a problem with that on a Thursday evening. So.
I set an alarm for that. Right. Okay. So if you actually like to watch a replay of this session to our viewers, it will be available on our Facebook page. And once again, thank you all for joining us, and have a very restful evening.
Thank you, guys.
Thank you. See ya. Bye.
Bye.